The stock market has set 53 all-time record highs since the election. For the first time in their lives, we want to protect those values. We want to keep those values up.
People keep saying this time is different.
I don't think we've ever seen anything like this. Cash keeps coming into these markets.
You don't see it ending well. I guess my question would be when?
Have you noticed something strange? Every time the stock market drops, buyers appears out of nowhere. Bad inflation data, market recover. Geopolitical tensions, market recover. Recession fear, market recover. Even after years of varying from economist analysis and doom and gloom headlines, the S&P 500 keeps pushing towards new highs. So where's the question? What if the biggest risk in 2026 is not a market crash? What if the biggest risk is betting again a market that simply refuses to go down? Welcome back to Shobha Financial. Today we are diving into a controversial theory that is spreading across Wall Street, Reddit, and financial Twitter. The idea is simple. The US government owes nearly $40 trillion. The debt keeps going. The money supply keeps expanding. And because of that, stock could continue climbing for a year even if the economy slow down. Sounds crazy? Maybe, but the end of the video you will understand why some investors believe we are entering the biggest wealth creation period in history, why others think we are building the large bubble event record, and most importantly, what smart investors should do right now. Let's begin. Imagine you borrow so much money that paying it back became almost impossible. What would you do? You could earn money, you could cut spending, or you could make the value of money itself worthless. Historically, government have often chosen the third option, not through obvious money printing, but through a slow process called inflation. Over time, inflation reduced the real value of debt. $1 trillion today is very different from $1 trillion 20 years from now. And that's where the theory getting interesting. Many investors believing that because the US debt burden is so large, policymakers will continue supporting economic growth, liquidity, and assets prices. In other words, more money chasing assets, which means a high stock price, at least in theory. And honestly, the evidence seems convicting. The S&P 500 continue making highs. AI is driving massive corporate investment. Tech companies are getting record profit and trillions of dollars remains parked in money market funds waiting to enter the market. But there's a problem. History has seen the movie before. Back in the later 1990s, people believing the internet would changes everything. And they were right. The internet did change everything. But the investors got carried away. The Nasdaq exploded higher. Companies with no profit reach $1 billion valuation. Everyone felt like a genius until reality arrived. Then the market lost nearly 80%. Not because the internet fell, but because the expectations became impossible to satisfy. The same things happened in Japan during the 1980s. Assets prices skyrocketed. Real estate became absurdly expensive. People believing prices could never fall. Then they did, and Japan spent decades recovering. The reason great stories can be true and investment can still be overpriced. Those two things are not mutually exclusive. That's the $1 trillion question. Some valuations metrics suggest the market is expensive, especially when compared with historically averages. Investors today are paying a premium for further growth, and much of the optimize it concentrated in AI related companies. The bull cases says artificial intelligence will increase productivity. Profit will rise, economic growth accelerates, and today's valuations become justified. The bear cases says expectations have become too high. Growth slows, investors panic, and valuations compress. What the truth? Nobody knows. And that's exactly why investing is difficult. Here are some things that rarely gets discussed. Even if stock rise over the next decade, that doesn't mean the journey will be easy. The market has experienced a 20% correction, 30% bear market, 50% crash, and yet over long period it still moved higher. That's why the statement stock go up over time. It's very different from the stock can't go down. One is historically accurate, the over in dangerous, because the moment investors start believing losses are impossible, rise explodes, living increases, speculations take over, and history starts a remake again. Personally, I am focusing on the three things. Number one, corporate earning. At the end of the day, profit matter. Number two, inflation trends, because inflation influence interest rate and interest rate influence valuation. Number three, investor sentimental. When everyone become bullish at the same time, risk often increases. Not immediately, but eventually. Remember, market usually doesn't crash when people are scared. Market tend to crash when people stop believing crashes are possible. So what should investor do? The answer is surprisingly boring. Stay diversified, stay investing continuously, maintain an emergency fund, avoid excessive leverage, and don't build your entire financial future around a viral prediction. Whether the market doubles from here or falls 30% first, the investors who usually win are the ones who surprise long enough to stay invested. Because wealth is not built by predicting very move. It's built by remaining in the game. Year after year, cycle after cycle, decade after decade. So now I want to hear from you. Do you think the stock market is entering a historic melt-up? Or are we witnessing the early stages of a dangerous bubble? Drop your thoughts below. And if you enjoy this breakdown, don't forget to like, subscribe, and turn on notification. Because here on Shobha Financial, we cut through the hype and focus on what actually matters. Thanks for watching. I will see you in the next one.